Hey everybody, it's me, Gregory Mannarino. How are you today? It is Tuesday, December 4th, 2018. People, we have to talk. Things are happening rapidly and some new developments are coming to light. And I want to cover that because they have profound consequences. Some of this is even being covered on the mainstream COD channels. You know what I'm talking about. Let's start off with this. About 6 months ago or so, if you were paying attention to any of the mainstream financial channels, they were parading out. I'm gonna be nice here. Very nice person after very nice person after another very nice person, who were very, very adamant that we were not going to have a yield curve inversion. Well, guess what? We do have a yield curve inversion. It just happened. And what are they doing? Now, they're taking these same people. You can't make this stuff up. And they're parading them out in front of the camera, trying to downplay the fact that we have a yield curve inversion. And I covered this yesterday. The spread between the 3 and the 5 is actually getting worse. It's not getting better. There's something else going on here that is not getting much coverage from the mainstream financial channels, also known as the Confederacy of Dunces. That is the fact that the 10-year yield is continuing to drop. Now, I have been reading the comments on this blog, and I love the fact that I see all of you paying attention to this. It's just so important. The Confederacy of Idiots, they want you to focus on the stock market, stock market, stock market. No, you're smarter than that. You know where you should be looking, and I take great pride in that because I've been pushing the fact for years, since the beginning, that it's the bond market you need to be watching. Now, with that said, the bond market is clearly showing signs of instability here. Again, the spread between the 3 and the 5 year is getting worse. A steeper inversion is developing. At the same time, the U.S. 10-year yield is dropping. So what's the setup here? Let's think about it. If the longer end of the curve is dropping, we get an inversion of the entire curve, and that's a problem. Now, let's talk about this. Well, I don't know if I should give any credit here, but I will, because I'm a nice guy. This morning, I don't know how many of you had the pleasure or displeasure, make up your own mind, of watching Jim Cramer today on CNBC. Jim Cramer used this word when he referred to the bond market this morning. I guess this is to his credit. Jim Cramer said that the bond market was distorted. Sounds like me. Maybe Jim watches my work. I don't know. So if Jim Cramer is now saying that the bond market is distorted, he has to also concede that the stock market is distorted, meaning it's fake. I hope he understands that too, and he's not trying to push the narrative that we're in a real market. I don't watch his show, so I have no idea what he says. So the bond market, people, is showing signs of instability. Understand what this means. Hold that thought for a moment. The dollar, which is also a unit of debt, is showing signs of instability as well. The US dollar right now, as I am doing this video blog, well, right before I did this video, is plunging. So we have a dollar here that's falling off of a cliff. We have a bond market which is unstable. Now, the bigger picture, I'm a bigger picture kind of guy, is this. And here's where the danger lies. Our central bank and every single other central bank on earth has chosen to rig the bond market, rig the debt market, suppressing rates now for over an entire decade. I've explained to you what this has done. It has created a financial monster, a bubble in the debt market unlike anything we have ever witnessed, has ever been thought of in the history of the world. And I am not just making this up. It's a fact. The distortions in the bond market, Jim Cramer's word, which he probably took from me, that exist in the debt market they're too big for anyone to actually get their head around. Anybody. I don't think anyone's smart enough, because there's so much hidden stuff underneath it, layers and layers and layers of derivatives as well. You understand that? I mean, I could go on and on explaining this, but to put this into a simple terms, the big picture, it's very simple. The debt market is the only thing, the rigged debt market, the bubble in debt, is the only thing that's keeping everything around us suspended. Hence, last week, the Trump-Powell put. Why do you think, again, President Trump, put party affiliation aside, is not a stupid man. He knows exactly where the issues lie. There's no doubt about it, in my view. Beyond any doubt, he understands this. And the proof is in the fact that he wanted the Federal Reserve to keep the easy money going, keep those printing presses going, keep adding digits to a screen, suppress those rates. Kept saying he doesn't want the Fed to raise rates, because he understands the environment we are in is only being supported by a rigged debt market. He's playing into this now. He is now an active participant in the rigging of the debt market. I know there's a lot of people who are going to say, well, he has to do it. Well, he has to do it. Granted, I explained to you yesterday that President Trump is playing the game because he doesn't want this to come down on his watch. No politician does, because that will put a whole bunch of nails in the coffin of whatever party is holding power right now. So if this comes down to President Trump's watch, I can't even imagine the next time we'll get a Republican president again. That would be it. Period. The end. Over. So every effort is going to be made to keep this propped up. But every drug has a side effect. The Trump-Powell put last week has caused an inversion in the yield curve, which is getting worse as I am speaking here. The spread between the 3 and the 5, and that 10-year yield continues to drop. So think of it. The whole curve is starting to go. This is a big problem moving forward here. Again, it's the debt market which has been supporting everything around us. The debt market is now showing signs of instability, and there are no models here. And I did allude to this yesterday, that when we get an inversion like we have now, although, look, the inversion we have now, let me put a perspective on this for you. Although it is concerning and it's showing some instability in the bond market, it's a small part of the shorter end of the curve, which, again, does raise a red flag. But it's the longer end of the curve that we all need to worry about. What I'm concerned about is the whole curve going over, because we've seen that before. Anybody want to speculate on when that would be? The dot-com bubble and the 2008 meltdown. We're going to get another meltdown here. I can't imagine, really. And I said this when all of the Confederacy of Dunces channels were saying, oh no, we're never going to get a yield curve inversion. It's not going to happen. Well, guess what? Idiots. Sorry, it did happen. And it has happened before. I can't imagine a way they can stop it. A lot of effort is going to be made to at least attempt to stop it, like I alluded to yesterday again. But the distortions, going back to Jim Cramer stealing my comment, my word there, in this debt market are they're off the freaking Richter scale. And when the debt market goes, that's it. The entire world that you live in right now, that you believe is real, and I know that's not you if you follow this blog because you get it, is going to change over freaking night. That's the truth. So keep your eyes on these things, people. One more thing before I let you go, and I know this is getting kind of long, but it's important. Stocks are down right now. Why is that happening? Well, there's a few things in play, but the big one, that's putting pressure on stocks right now. Last time I looked, the Dow Jones Industrial Average was down 170 points. Dollar getting slammed, instability here in the bond market, gold and silver catching a bid here. It's pretty simple. There seems to be a discrepancy with regard to the trade truce. I don't know if you're hearing about this yet, but look it up for yourself. The Trump administration is stating that China has made certain concessions along with this trade truce. Well, China's saying, hold on a second, we have made no concessions. So again, it's the lies that are coming out of probably both sides. Maybe the truth is somewhere in the middle. We don't know what actually did happen here, but that's rattling the stock market. It rattled the Asian markets overnight. So we'll see. We'll see how this plays out. But are you surprised to hear this, that, you know, one side is saying one thing and one side is saying another thing? I'm sure you're not surprised. It's the falsehoods, lies, and deceptions that they're trying to fist feed you and me and everybody else. It's a distraction. It's a distraction. And focus on what's actually going on here. The instability in the debt market. The instability in the dollar. Falling off of a cliff right now. The dollar is a unit of debt. These are not good signs. And all of this, everything around us, is dependent on what's going on in the debt market. Hey, look, if you have any thoughts that this video is important and people need to see it, please share it. Please get it out there. Again, if you're on my team, I'm counting on you to do that. Let's get more people to understand what's happening in reality, not in the fakery that's everywhere. I'll see you at the end of the day.